Ladies and gentlemen, I was staring at the wrong clock. It was off by like 3 minutes, so my bad. Anyway, we're here. Devis, how you doing?
Doing well. Just the two of us, I think, tonight, unless Steve's joining.
Yeah, I think we'll get Steve in here as well. But until then, we can talk a little SoFi, talk a little Robinhood, maybe talk about other investments we've made, like the trade desk, and how I've apologized to the to the people, and we'll never do that again.
For buying the trade desk?
Yeah, it's down like 40%.
Yeah, I was thinking of writing some puts on it today, actually, but and then I was like, you know what? I'm not gonna touch it. I haven't read anything about their earnings. I don't know anything about anything. So
Yeah, I think great company, great management. I think that the market had, or at least what the market is trying to perceive right now.
can you do the bigger split view? There you go.
Is that maybe the people who have invested in the trade desk have underappreciated its competition, and that although the space for advertising is growing fast, the trade desk is maybe not growing as fast as some of their other players. That being said, I also bought AppLovin on the dip during earnings, and that's up pretty decent. I think I'm up like 25% in the last like 2 or 3 days.
Yeah.
So
I mean, I had a fairly good week because both Lemonade and Nebius jumped up like 20 to 30% off the back of each of their earnings, which was great. I mean, great because I hold both of them, not great because I'm still like buying actively, but great.
yeah. And your Joby shares are doing well.
Yeah, well,
Well,
I think your Joby shares are doing well as well, right?
actually, dude, it's back down to 16. Well, it's fallen 12.6% in the last week.
Wow. That's
We're still up 61% in the last month, but yeah, we were up a lot more. I think we were at like $20.79 at one point for your Christmas gift.
bro. Yeah. It's a sign of the times. My aunt, who the one that I tell you guys about, who is like a degenerate gambler, she was just like, so I put her portfolio 50-50 SoFi HIMS, and she's had a terrific year. Her portfolio is like over double or something.
Yeah.
And now she's like, I have some more cash. What should I buy? And she asked me on Friday, and I was like, don't buy anything, just stay in cash. And then she asked me again on Monday. She's like, I want to buy something. And I was like, buy Lemonade or Nebius. And I was like, but honestly, like just stay in cash because like we might have a pullback. And then she messaged me this morning with like the 5-day charts of both Nebius and Lemonade. And she's like, what the fuck? Like, why? It's like, why? She's like, why didn't you push harder? It's like, yeah, it's earnings. It could go either way.
Yeah, man. The mode for artificial intelligence is so like still risk on. The investments continue to push forward. Multiples are expanding. It's unbelievable. And aside from that, in financial services, I don't really care to be elsewhere. And I think that's been pretty relevant after all of the talk and want for me to get into healthcare. I just have not cared at all. I just care about artificial intelligence and financial services. Well, actually, that and advertising, which still falls into a lot of tech and everything, but those are really the 3 areas that my entire portfolio consists of.
Yeah, well, you also have way more holdings than I do, so you're much more diversified.
What are you at right now? I thought you had more than me.
I don't think I have more than you in terms of just equities, like excluding the crypto.
Sure, I only have 3 cryptos as well, but yeah.
1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yeah, 10 positions.
Okay. I think I'm at 17 or 18 right now. I need to trim back again, but I've just seen some. Well, actually, if you include the community portfolio, I think I'm at like 100.
Okay, well, no, I mean, I'm not including the community.
Yeah. But I have recently taken investment in SBET in AppLovin, in Shark Ninja.
Oh wow.
Bunch of different stuff.
Joby.
No, not Joby.
Nobody's gifted you Joby for the community portfolio?
No, I have that in the community portfolio. Those are in my real portfolio. The names that I was saying is in my real portfolio.
Wow, so you only have 17 positions, and of those you have SBet and Shark Ninja as positions?
Yeah.
And then I also know you own Shopify, Nvidia, SoFi, Nubank, Shift4. You don't own any PayPal.
No.
You sold all your Tesla.
Yeah.
You own Google, I know that. You own Amazon.
Mm-hmm.
I can probably make your portfolio. I can't make the compositions, but I can probably get 90.
You'll miss out on a few, but yeah. If you look at the stock draft,
Do you
you'll
still
see a
own
lot
Adyen? Do you still own Adyen?
No.
Yeah, I have
Salesforce, ServiceNow, Airbnb.
You have Airbnb too, hey?
Yeah.
That's interesting. Yeah, Salesforce is an interesting one. I thought about that. I don't know, man. It's just
Nubank, Mercado Libre.
Yeah, I struggle so much to go into companies that are so like large cap companies. If that makes sense, and I probably should because they'll grow at a slower pace, but at the same time, it's going to be like you just go to sleep and they'll grow.
Yeah, I kind of switched that very like I don't know. It was fine whenever companies whenever you buy a company low and then it grows into a mega cap, like what Tesla has done for you. You have no problem holding on to Tesla and buying Tesla at those rates because you know it. But it's very hard to buy Microsoft, right? But I've gotten really comfortable after adding to NVIDIA at really high levels that I'm like, you know what? Google looks just as exciting. Well, not just as exciting, but Google looks really exciting. Amazon looks really exciting. We just saw a study that came out this week that said that the top 10% of equities now make up for the highest percentage of market cap than ever in history, at over 78% of total market caps in the stock market. The last time it was that high, which was like 77.9% or whatever, was 1929. So,
I mean, not a great comparable.
yeah. People look at that and they go, "Oh, you wonder if you're in a top right now." That being said, there's a few names in the top 10 in the top 10% with really exaggerated multiples, with future earnings maybe coming later. Okay, like Tesla, for example. You don't have to be like I'm not even bearish on Tesla. I'm just saying like you look at 190 PE, you see 190 PE. Anyway. But whenever you look at the other names, like Google's growing, Amazon's growing, Meta's growing like crazy, Microsoft, like they are accelerating in high double digits, and they're the biggest companies in the world. So,
which is unfathomable to think about because it totally breaks this like paradigm of what you thought, these established companies were, where now they have the biggest war chest, they can maneuver, and they can corner entire markets. They can diversify across the board into new verticals and start disrupting smaller players into those verticals. And they can still maintain a double-digit growth rate, even though they're trillions of dollars of market cap. And you're thinking to yourself, like, why am I trying to bend over backwards to find these smaller cap companies when you literally can find the mega cap that has all the same traits that you're looking for?
What's the next scariest part is that there used to be monopolistic practice stopping by not allowing businesses to acquire or slow down their competitors. And that would be governed by SEC and a bunch of different agencies as well to try to slow down those practices. Now, Meta, instead of acquiring any new businesses, is just acquiring all of their talent. Like, it's kind of interesting. Like nothing's really stopping them from just hiring someone and paying them $300 million to come over. But that essentially cripples the brain share of those other AI businesses. You take all the smartest minds away from OpenAI. What the heck is OpenAI? And
I mean, apply it to any company, but sure.
No, exactly. I'm just that was the area for which what Meta had targeted a lot of their
It's
staff.
funny. I got drinks with some of my work friends yesterday, and we were talking about that show Silicon Valley. Like it's like a satire.
Yeah.
You've definitely seen it. And one of the jokes in the show was that the main company Huli, which was like this like Google-esque, who was modeled on, would offer these ridiculous 5-year contracts to engineers and basically have them do nothing just as a way to block their competitors from getting those same resources. And I'm like, we're seeing that right now. Like, even though Meta might not need an AI engineer, they get leverage to get that AI engineer. Yeah, put him on the roof and have him play darts for 8 hours a day, just so that OpenAI can't use them or whomever else can't use them.
Google's been doing it forever.
Yeah.
Except they would pay them $1 million, not excuse me. Switching topics. You're a Celsius drinker. Based on
start swearing on the stream, Tanner.
Based on the color of this drink, what flavor do you think I'm enjoying right now?
Bro, I don't look at the color.
I bet you know.
I don't know, the tropical one.
Yeah.
There's only 3
this guy's done so much DD on Celsius, he could tell you which drink is on the rocks. It's incredible.
I mean, that also went up quite a bit today. Or this week, I mean.
Oh, yeah, I didn't follow it.
Well, they had earnings as well, right? So, yeah, I appreciate it quite a bit.
People are just naming all different things that are just not related to Celsius at all. Mountain Dew, Gatorade color, mango.
Yeah, so I think the added context here for people is that we only get 3 flavors really up here. So it's pretty easy.
I think we're up to 5. There's only 3, or I think we're up to 6. There's only 3 that are in Costco, though.
Costco, yeah.
Which is how I get it, at least.
So
let's talk some SoFi really quick. And by doing that, I wanted to have a conversation with you. I was actually going to transition away from the big tech talk into SoFi, because this is one of the things that I find very interesting. Is everyone talks about large banks and like saying, oh, there's 6,000 banks in the States. And now with this high concentration of market cap in big tech and just the top 10 or top 10% of companies in the States making up for 79% of overall market share, I think that that's going to happen in financial services as well. Because I think one of the things that had stopped the companies previously from growing that big, other than in the Great Depression where multiples really expanded, was just the ability to be localized to an area, because you're literally selling physical product in a physical location. So there would be companies that are set up in the West, there would be companies that are set up in the East, the North, the South, and they'd all expand inward, right? So JP Morgan and Bank of America and Wells Fargo and Citi and all these other, municipal and smaller sized banks could also grow simultaneously. However, in a more online environment, I wonder if financial services will start to concentrate the way that traditional internet services have concentrated into a few names for competitors.
Yeah, I could see all industries, doing that to varying degrees, right? Because you're going to have, and like the only thing that stops it is really regulation, right? Whereby you can't corner the market because regulators are going to stop you. But all industries, you're going to have a scarcity of resources because you're going to have a centralization of all of the capital. And then from there, you just buy up smaller players. And Canada, I think, is like the best example of that, because any new player that enters the Canadian market is either bought up, by a competitor, or they're not really allowed to enter. Granted, the US is a little bit more of a perfect competition in that sense, but the same applies, right? Because otherwise, what are you going to have, right? Like I think about this, online financial services space almost like the debate between cable and cutting the cord for streaming services, because the argument was like, oh well, streaming services are cable by another name because you're going to subscribe now to 3 or 4 or 5 of them, and like that was the same as it was with cable. And like I do think that there is going to be a threshold where the vast majority of people are going to have, up to like 3 institutions, and then it's going to fall off a cliff from there. And then you have the people who are like churning credit cards for points or whatever. But realistically speaking, you're going to have one financial institution that you have your primary, what is it called? Like where you put your salary in, your
direct deposit relationship or
direct
primary
deposit.
banking relationship.
Exactly. And then everybody else is like extra to that, and they don't get a lot of volume off of your business. And it becomes really difficult, right? Because at the end of the day, it becomes a race to zero with a lot of these financial institutions for what they're going to offer a consumer to coax them over, especially because traditional financial institutions offer really great onboarding promotions and then really not much after that because the lifetime value is so long. But I think that now that everything is online, that lifetime value is going to diminish and shorten somewhat because the switching costs are less as you get more of these different alternatives with unique benefits. And the last thing I'll say on that is that you also do have some network effects in the case of Robinhood or SoFi, for example. Like if they have the brokerage and the bank and the crypto and all these other things, like the network effects are a really big deal. Like right now for Canada, for example, we have Wealthsimple, and they just released their credit card and their checking account, and they started off as a brokerage, and now I can manage everything in one app. Basically, I can manage my banking and my investing in the same app. And then next, I'm going to be able to, see my mortgage on the same app, and so on and so forth. And that in itself is larger than the sum of the parts individually.
Yeah. No, I think that we're probably going to see a number of like 6,000 banks probably get drawn down. And this is over decades. I don't think this happens soon just because the amount of old money will just live for a very long time. But that'll probably get concentrated down to a few hundred of like really good players that are going online, bringing over their old relationships that direction. But yeah, let's talk about some news this week because we also saw Chime put out this earnings this week, as well as SoFi get a lot of new news around benefits that they're giving out to customers, new institutional customers that are potentially buying SoFi, or indexes that are now adding SoFi to their index now. Crazy.
Yeah, and I think Upstart also reported earnings as well. I haven't, other than the Jane Street news, I'm not up to date on any SoFi news this week. I just haven't been paying attention.
No problem.
I've mostly been on other names.
Do you want to start with the Jane Street news, and then I will talk about the other stuff, and then I can get your opinion on it.
Yeah, Jane Street just came out with a massive allocation into SoFi at like $20.84 or something like that. And they now own 5.5% of SoFi, which is kind of baffling. It was 65 million shares that they picked up casually, and it's now 2.5% of their portfolio. They own more shares than BlackRock does of SoFi. They're the second biggest holder, and it seems as though Jane Street might have also been the institution that picked up the $1.5 billion offering that SoFi had last week because of their average price. And the offering last week was about 83 million shares, and Jane Street picked up 65 million shares at $20.84 average, something like that. So it's very, very likely that they were the biggest participant in that offering.
Yeah, I think they picked up roughly about 60 million because I think they had 5 million before, was my understanding. But yeah,
right.
Still the largest ad for sure. And honestly, also, go ahead.
That really puts a floor, I would say, on the stock to not break beneath the $20 threshold.
Dude, happy you brought that up. Like, it is so much more comfortable handling bears in the $20 ranges. It's just so nice. And I think that it actually goes so much higher. We were talking on the phone the other day. Like, I'm back in accumulation mode for SoFi. I'm buying shares now on a constant basis. And because I actually think that we go a lot higher based on what I saw in this quarter. Like, we were really bullish. I had the highest member prediction at 840,000, and we came above that. Roy's financial services numbers, like, we were laughing at him. We were laughing. We're like, "What? Where are you getting these numbers?" And he wasn't bullish enough.
Do you want to hear? Do you want to hear my my latest SoFi trade? Actually, you know what? If there's enough demand in the chat, I will share with you my latest SoFi trade. But otherwise, I'm not.
Yeah, we got to get enough likes on the video to get that. There you go.
Yeah, but, I just put it on today, and so yeah, I think people are gonna like it, but we'll see.
All right. Before you announce that, let's also announce that MSCI, which is essentially the benchmark for all tradable securities and investments, ended up making changes to their equity investments. They added some large names, particularly in US markets, adding Rocket Lab, Affirm, and SoFi Technologies. So MSCI now holds SoFi, and just to put it into perspective, that nearly 17 million in assets are benchmarked to the SMCI indexes at the end of 2024, and in equity ETFs linked to those indexes, specifically for the equity ETFs, is another $2 trillion. Or not another 2 trillion, but is $2 trillion. So SoFi is not going to get 2 trillion worth of assets given or like added to the books because of this. They're going to make a sliver of this index, but it just goes to show you that more institutions are going to be paying attention to this name. There's more money that will have to be benchmarked to SoFi's name and add a floor to the investment. And this hasn't happened already. The investments from this is not priced in today. It happens on August 26th. So, in my opinion, August 26th and beyond will have a little bit of interesting volume that ends up coming in for SoFi and Affirm. And I'll be interested to see what happens there. But yeah. Then I'm sure you have covered calls or something that are going to end up getting taken away from you. I actually just wrote a bunch of covered calls on NVIDIA today. So I love this strategy, by the way. I really appreciate finally listening to everyone and adding to this, because it literally is just free money for me.
You love it until you're underwater, because you haven't been through that yet. But yeah, just wait. Because I'm underwater on like 4 different tickers right now. I'm like, oh man, I gotta manage these.
Yeah, but you're not underwater though. You're still up. You're just not as up as you could be.
Yeah, no, of course, sure.
Yeah, that's what I like. There's no downside here. Like, oh, I'm forced to sell out of a position at a lower cost. Like, okay, but unless I'm writing covered calls on positions that I'm lower than my cost basis, I mean, I'm good.
I posted all of the screenshots when I was doing the wheeling portfolio on SoFi, and I let all 7,500 shares go at $16, and I just calculated the difference, and it was like 60 grand worth of profits from like where it's trading now to where I let it go. And like, yeah, sure, technically I didn't lose any money. I actually made quite a bit of money, selling cash secured puts and then covered calls, because I got at a position at like 11, 12, and I got rid of that position at 16 in a matter of a month and a half. But it ran much higher than 16. So that's the thing. When you do the math, you're like, oh man, that's crazy. But I still have in a long-term position, which I'm fine with.
Yeah, no downside. Famous last words. No, I mean, like, I'm not even like making it like, unless the downside is it might force me to hold a position, and something could happen during those 2 weeks that I'm writing those calls, and I maybe do not want to be in that position. That could be a potential downside, that I'm forced to hold this position or something. But aside from that, I'm like maybe it is like getting married. When Tanner gets married, there is no downside. Yeah, I'm kind of marrying into that position for 2 weeks and can't do anything about it. But for Nvidia and SoFi and Hood and these positions, I feel very comfortable holding those positions. And Tevis used to make fun of me, and probably still does. I mean, just end the sentence there. No, on how risk off I am whenever I'm writing these covered calls. I mean, I'm far out, way out of the money. I've not had to roll one. And I definitely make a lot less money doing that, but I was making no money before. So very happy. Happy camper. Thank you, Tevis. Thank you, TJ. Thank you, Steve. Thank you, Amit. Appreciate you guys. Thank you, Roy. But let's also talk about two other things that happened this week. SoFi announced, did you see the 4.5% boost on APYs? The boost on APYs to get to 4.5% in the checking and savings?
I did not. I think
Okay.
I'd seen something like that, but I didn't really. I've been back on SoFi News this week.
No problem. No problem. Essentially, what SoFi, if I can find it, they ended up showing off how if you start using, or if you switch over to SoFi Plus now, they'll boost your APY up to 4.5% rather than just 3.8%. So they're giving you 0.7% higher APY if you go to SoFi Plus. I think it's between now and September something.
Nice.
Okay. And the reason they're doing that is they want more SoFi Plus users, obviously.
Yeah.
So here was the promotion that was found. Fuel your savings with a 0.7% APY boost. Here are the necessary steps. Open a SoFi checking and savings account by September 3rd, 2025, and become a SoFi Plus member within 60 days by setting up an eligible direct deposit or enrolling in the $10 a month subscription. Enjoy 0.7% APY boost on savings for 6 months as long as you maintain your SoFi Plus membership. Now, the interesting part about this is that this is not the first promotion that they've done. They've done this 2 times before. And so clearly, it's in my opinion that I think that it's worked out for them positively on the unit economics, that people are actually staying past their benefits and their upgrades. And this is them putting a lot more money in today to attract users for more user growth. Everyone highlighted and gave Robinhood a massive benefit in their stock price for doing this. Okay. Like, hey, they bumped up sales and marketing. They're giving 3%, for people switching over their retirement accounts. The market approved of contra revenue for Robinhood going from 5 million to 50 million. SoFi now, after doing that, just ended up rolling out even higher rewards. For eligible members where their employer allows them to do this, they will give 0.8% APY boost, so more than their own users, to SoFi at work users that set up what they call emergency checking and savings accounts, which are just SoFi Money. That's all it is. SoFi Money accounts get a 0.8% APY boost if they came through the funnel of SoFi at work. This comes after the Paychecks announcement, which you guys laughed at me for. Okay. I'm telling you, this is going to be huge. I love that they're spending a bunch. I hope their margin falls. I hope that they grow so fast that the margin falls, because then we're going to get million plus users. Robinhood, for example, which had a great quarter. I'm not bashing anything here. But without the Bitstamp acquisition of adding 520,000 members, they only gained about 200,000 new members quarter over quarter. Okay. SoFi gained 850,000. No acquisition, completely organic. CAC costs increased very marginally.
Yeah, it's interesting because this signals that they're just going back into user acquisition mode for the upcoming quarter. that, okay, well, these are the input signs that you can have to feasibly get to that 1 million member quarter that they have guided for so long, that they're going to stair step towards, um, because like they just want to accelerate their growth.
And not just user acquisition, right? These are not advertisement campaigns that are just going out. I mean, that'll be part of it, of course, but this is
They're doing like a hub and spoke thing, right? Like they just want to get as many people as possible into the SoFi Plus as like the subscription product, and then from there you can get all of these different benefits, and by doing so, cross sell into different product lines.
I don't know if you saw the other promotion for the SoFi Invest thing, but they also said, hey, SoFi Plus users for the next 3 months or whatever, they're doing these temporary promotions like crazy. Get twice the rewards, welcome bonuses. I think it's like that type of bonus where you can get stocks up to a certain value, up to like $2,000 or whatever. And it's randomized almost like a very small percentage of people get 2,000. The average person might get $15 or whatever. But they doubled that reward for people who are SoFi Plus users who are getting SoFi Invest. Okay. It's just, they're turning up the heat on not just getting new users, but specifically SoFi Plus users.
SoFi Plus revenue accounted for in financial services.
Yeah.
Yeah.
Yeah. But if you look at
would that be mixed? Like, because that's not that's non-interest income, right? Wouldn't that be mixed with loan platform business income?
No, but well, it depends on how far out you want to disaggregate them.
Aren't they both non-interest income though?
Yeah. So if you're just looking at non-interest income, yeah, then they're mixed. But
Right.
if you look at the line items of like loan platform business, referral business, interchange, brokerage, stuff like this, it'll be in the other tab. But the amount of people paying $10 a month, I would assume, is pretty small. I wouldn't imagine we're making even $1 million a month. Like, I bet it's really, really small.
Yeah.
The amount of people going direct deposit, however, is what I would assume is 99% plus here. I mean, like, high.
Well, that helps them on the other side too.
Right. It's just like, I don't think you're going to be able to find this in a line item in their revenue. I just think all revenue is going to go up. The deposits will go up. The amount that people are spending will go up. The amount of loans that people are taking out on SoFi Plus will be higher than non-SoFi Plus users because they have a discount.
Which is crazy, right? Like it's like that Amazon model where I pay Amazon Prime and then I do more business with Amazon, even though I'm paying them a subscription. It's the same thing here. You're paying SoFi a subscription for SoFi Plus in order for them to take your direct deposit money, which they then go and turn around and use for their lending business. Like,
but it's even better than Amazon because the biggest whales on Amazon are actually not. They lose Amazon money. They make more money on the people that don't use Amazon, like that pay for Amazon Prime but don't use it, because the actual shipping costs are really expensive. You know, you can actually pay for Amazon Prime pretty quickly, and like same thing with Costco. Like, you can actually make it worth it where you're benefiting more than what you're paying for. But for Robinhood Gold and SoFi Plus, they don't have any loss leaders. You know, so I'm getting 4.5%. I'm getting 4.6% APY. All right, they're lending that out and they're getting 13%. Like, there's no loss leader here. There might be things that have smaller margins, but there's no negative margin. You know, so I love Robinhood Gold. I love SoFi Plus. They're both amazing. And I don't know if you also saw this week. JP Morgan increased their maintenance cost on their accounts from $12 a month to $15. You could buy a subscription to SoFi Plus and Robinhood Gold for the same amount that JP Morgan wants you to pay for an account to get 0.1% APY. Insane. Like, they're not even trying, bro. Like, Robinhood and SoFi are just walking in the front door.
Why would they even increase it? Like, they don't make any money off of that. It's not like, if you can find where in the JP Morgan earnings report you can see the money that they make off charging your account, like, if that's not a rounding error, I would be shocked. And yet they increase it, like just take it off altogether. It won't make any difference in your financials.
Yeah. Completely agree. Completely agree. But honestly, it's to my benefit that they're not.
Oh yeah. No, they're actively like pushing people away.
Yeah. Yeah. And honestly, the people who are there are very sticky and loyal customers. But you look at the well, actually, SR puts in a comment, but I swear this is true. So and I'm not kidding. They don't have the tech stack to.
That's all banks though.
What?
That's all banks though. Like they give you money when you have money.
No. But all I'm saying
owe you
is
money when you can't pay your bills.
I don't just mean loans. I mean the ability to host someone's account that comes in with $50 of deposits they're losing money on those accounts. So this is what happened in Latin America. And this is the reason why I know this so well and why SR knows this is that I was studying Nubank and Mercado Libre and all these accounts. And the reason why FinTech blew up is that they would turn them around at the door because if they didn't have enough deposits to put in the bank, for them to meet an advisor, okay, so this is an hourly rate coming from someone, and the branch costs and the setting up of the accounts, it's too much on an hourly cost to afford them to even have that account with a big bank if you only have a couple $100.
Yeah.
At Nubank, because they set up all the applications all perfectly automated online and it's hosted on AWS, and the cost to maintain the that data on the cloud is so small that they can still lose money on small dollar accounts, but it's so marginal that the larger accounts pay for them. But JP Morgan doesn't want to see any negatives. So they're literally bumping this up to kick away the small dollar accounts. That's what they're trying to do. That's what SR is pointing out in chat.
Is Nubank reporting next week?
Yeah.
Yeah. Excited about that one?
Not excited, anxious. We'll see. We'll see. It's the most uncertain I've felt. I don't think it's going to be bad earnings, but crazy changes in currency, changes in their app rankings recently. Trump's not a happy camper with Brazil right now. It's just more uncertainty than I felt recently.
Yeah, I mean, I was shocked this week when HIMS missed on the revenue number for the first time in like company history. So if it can happen to them, it can happen to anyone. We'll see what happens. But like, yeah, Nubank gets hit mostly on the currency stuff, even though they triple beat all the time.
Yeah. Yeah. Overall, I have high hopes for them. And literally, David Velez might be one of the best CEOs of all time. And you hear it, like, if you ever hear a speech of his, listen to a pod. You're going on a road trip, listen to a David Velez podcast and be like, wow, this is Satya Nadella. I mean, he's one of the greats. So yeah, big fan. Overall though, from SoFi, we're seeing them really ramp up their marketing spend. We also, we got July website traffic for FinTechs this week. Did you see any of this or no?
Nah, dude.
You watch my videos, yes or no?
I'm not a full-time YouTuber, Tanner.
Okay.
I make content in between meetings.
What is that? What are meetings?
I know, exactly.
Okay, well, that doesn't look great. But anyway, here's SoFi. They just put out July numbers, 22.4 million visits, 10% roughly increase month over month, 35% increase year over year. Awesome. Robinhood,
wow,
massive increase. This is what July is doing. I mean, the amount of just retail buying in of stocks and options and crypto and everything was just insane. So they found the new highest record amount of website traffic.
Wow. Is that like a seasonality thing? Like, why do we think that is? Because, okay, like for SoFi, I could
July
say,
had the best freaking numbers ever.
Yeah, so I don't understand why. Because okay, like if it was just one of them, I could say they're investing in their growth. But if it's every fintech is seeing surges in July, then it's something to do with the macro in July.
So, well, a couple things. Well, the macro is like, bro, look at what happened in like when I don't mean that they're at their highest. I mean the stock market is at all-time highs.
Yeah.
Like July was just hot, right? So that gets people back in. Like retail doesn't buy when it's red; they buy when it's green, right? This is the most green month we've ever seen was July, so of course they're coming back. Is that all SoFi brokerage? I don't know, but that's probably definitely a part of it. And then you also saw Upstart end up putting out an increase in July as well. So what I'm thinking is capital markets are very hot right now, and they're able to sell loans. So Upstart's entire business is SoFi's loan platform business.
Wow.
Okay. So if they're doing hot, that means most likely SoFi's also doing very hot.
Well, I mean, SoFi fell on the back of Upstart's earnings. Upstart like pumped initially and then just dumped after hours, and then I think SoFi was down like a couple percentage points on the back of that as well.
Those are idiots. It was like the parts that we should have taken away from Upstart is that banks are really hungry for loans. That's the part that people should have taken away from it. Upstart ended up showing a decrease in their take rate and an increase in their default rates.
Like banks are really hungry for loans, as in like deposits, or do you mean to?
Upstart partners with.
So like you're talking about the loan platform business essentially, like that's a comparable.
That's only their business.
Yeah, so that's the parallel you're drawing for SoFi.
Yes, is that
the demand to purchase the loans.
What?
The demand to purchase the loans, not necessarily the demand to collect deposits from users.
Correct. That there's more Blue Owl and Fortress Group deals and whatever that other one was called, Invest Edge or whatever. More of those deals are coming through for Upstart. And so whenever they get, because they have no money of their own, essentially, they do, and they can originate loans on their own, but they don't really. They're not a bank. So they can only do it so frequently at such little numbers. But so they need to go out, and the only way that they can grow is if money is coming in from institutions, and then they can go out to the market, like literally Google advertising, Facebook advertising, and say, find me a hot lead that's looking for a personal loan, that's looking for small dollar loans, find the people who are looking for payday loans and reach out to them saying, hey, Upstart might be right for you.
Yeah.
Okay. SoFi does that too. But Upstart, that's all they do. So whenever you see increases in their traffic, it's because people are clicking through on their advertising. There's no other reason for someone to go to Upstart. That's the only problem with SoFi, is because they are like a one-stop shop. Are they coming for the brokerage? Are they coming for relay? Are they coming for loans? It's harder to tell.
Right.
So the data that I'm seeing is that Upstart is seeing a lot of demand from institutions. And that is probably wide, like that's probably across the board. Whenever Facebook does really well on the advertising side, it's probably likely that YouTube did well on the advertising side, Google did well on the advertising side, Amazon advertising. So this is capital market activity. If Upstart does well, there's a high chance that SoFi is also doing well on that side. The only difference is, okay, Upstart's defaults went up and take rate went down. That's why the stock fell. SoFi's quarter, in the exact same period, defaults fell and take rate went up. So we have the macro, that's what they share, but the actual underwriting and the quality of the loans and their ability to sell is company specific, and SoFi's doing better. So what the heck? Why did it sell off?
I think the interesting thing, regardless of why the stock sold off, I think the interesting point here is that in terms of their underwriting in isolation, like Upstart uses AI, and then SoFi has said multiple times that like we refuse to use AI underwriting models. And I think extrapolated over a certain number of quarters, you're going to start to see the discrepancy there.
In terms of
like fine tuning the underwriting models, and that's going to reflect probably in the take rate over time.
Sure. what's interesting is the more loans that these companies underwrite, the better they're going to get, right? The more data that AI takes in, the better they're going to get. And that's the same thing with these AI models as well. Or sorry, not AI, these underwriting models as well.
Yeah.
And so SoFi before could only underwrite as much as that the loans that they could take in and have the appetite for. But now they're trying to have appetite for the entire market. Okay. That's a completely different space. Like, so I'm very, very positive on SoFi right now. That's why I'm acquiring shares again. Do you want to tell us what you're doing with your SoFi position or whatever you're doing?
I don't know. Should I? Do you want? Should we leave it for the after hours? No.
We can wait till the after hours.
Should
But
I?
thanks to Dookie Pie, almost everyone is going to be there because she made my entire chat green. But
oh wow, that's fun. Yeah, Dookie Pie comes on my stream from time to time and donates like just carpet bombs me with $1 bill donation. All right, cool. I'll share with you a little taster of what I had.
This stream.
What I had today. Yeah, sorry. Yeah, Dookie Pie needs to come on my channel and throw the $1 bills. I said this last time. I think it was on the him stream. It was like $1, $1, $1. I was like, Dookie Pie, I'm like a stripper here. And you're just throwing singles at me. All right, this was my my trade. You guys ready?
I'm ready.
Yeah, this is it. This is it, baby. Tanner, explain to the audience what this means in simple terms.
F if I know. You tell me. I got distracted by the forest background as well.
look at the audience. What does this mean, Tanner?
You sold puts on SoFi.
Yeah.
You're wanting to buy more at $23 for August 29th?
Yeah, so basically if the stock is above $23, then I collect the premium, which is $1.55, and I make out like a bandit. And if the stock is under $23, then I will be assigned the stock at 23 minus 155 for my break even essentially. So
yeah. So what you're saying is if you have the curse, we're not getting above 23 by August 29th.
I don't know, man. People want me to do things that make stock go up. So this is it was because I have covered calls as well, right? So if if the stock goes down, then I can get my covered calls out of being underwater, and then if the stock goes up, then I collect a little bit more premium. My covered calls are like they're gone, but at least I get more premium for that decision. So that's my little aggressive. So if I play, obviously it's sized accordingly, where it's not like a crazy amount. It's only 10 puts, but we will see what happens. Let's see what happens.
Yeah. I'm just buying in the open market. That's it.
That's too pedestrian, Tanner.
I know. I'm a basic man.
Too garden variety investor of you.
I'm a basic man with basic needs here. And then maybe I'll write some covered calls on SoFi. Way out of the money. That's what I like. That's what you guys have taught me. That's what I'm doing.
What's way out of the money for you? Like what's a Tanner strike price? Give me the date and the strike.
Well, I don't have any for SoFi out right now. I can tell you what my NVIDIA ones are right now.
Sure. What's it? 184 or something?
Oh, I thought you were saying my things were at 184. I was like, are you ridiculous? No, I think it's 182. I think it fell a little bit. I did it whenever it was like 183 today.
Sure.
Here, wait.
His is gonna be like 250 for next week.
No. Okay, it's 182.70 right now.
Yeah.
And let me just check what exactly it was. So I didn't want to go through earnings, so that was the only thing that was stopping me on the time frame. I did 195s for August 22nd.
Okay. I mean, that's not like crazy. What's the delta on that? Like 10?
I think so.
Yeah.
Yeah, I think it was 10 or maybe 14, something like that.
So that's not bad. Is that your
It was
entire
10.
video position that you did?
No, sorry. I changed my mind again. It was 14.
What, the delta?
Yeah, it was 14, which is probably the riskiest that I've done.
Wow.
Ever.
That SoFi trade was 61 delta.
Really? I think the most I've done or the range that I've done them before was like 7 to 10%.
Yeah.
But yeah. 195s for August 22nd was the thing.
August 22nd. Yeah, I mean, that's not bad. Is that your entire NVIDIA position you're doing that on?
No.
Okay. That's a good answer.
No.
I'm just waiting for you to get underwater on your entire NVIDIA position and then just come on stream just looking completely deflated. Like, how do I handle this?
It's not a 14, it's like a 0.14 delta. But it's just easier for me to say.
Delta can't go over 1, so it's
Yeah.
implied it's 0 point.
Yeah. 61 delta is good.
Yeah, exactly. That's like you're in this, like you got to collect the premiums, and if you put the shares, then who cares? Like you're bullish anyways, and I can sell covered calls against it. Same thing that I did, at $12. I'll do here.
No, that's fine. I'm doing covered calls on my position, so I don't want to get up to 60% chance that it ends up getting closed on me for selling my favorite stock in the market.
I mean, I let all of my NVIDIA shares go at what, 155, I think.
Yeah, that sucks.
So what?
It's 182.70.
Okay. Like, it's not like I'm just sitting on, like, I'm still using that money to write.
Yeah.
But yeah, like in a market that like is so hot in July, for example, June, July, like you're going to get everything underwater. So we'll see if the market pulls back a little bit, then I can just escape. Yeah, one delta is the best.
Yeah. What's it called? Yeah, I have never had to roll or do anything along those lines. Got pretty scary for me on my NVIDIA shares previously, but didn't end up.
Yeah.
And then even if it did hit my strike, it would have been like right on the price. Hood sell 10 put contracts, $85, January 16th, 2026.
Wow, that is.
Explain to me what he's even saying here.
I would do that. So he basically collected $6,000 in premium because he's saying if Hood is under $85 by January 16th, 2026, he has to buy 1,000 shares at $85.
Okay.
So basically, he's betting that Hood will not fall below $85 by January 2026.
Okay, and if it's above 85, he just collects the premium.
He just keeps that $6,000.
Bro, I'd do that all day.
That's what I'm saying.
I would do that all day. We're at 114 or something.
Yeah. I like that. I can't believe that the premium was so good.
Either is that today or is that written a long time ago?
I don't know. He probably, it's 1,000 shares. That's why the premium's so good. Well, that's a great play, Howard. Honestly, like I think in this market, you just have to do it with cash secured puts, man. Because
it being 1,000 shares is not why the premium's so good. They could do it with one contract. He's just saying, like, the price doesn't get better if you buy in bulk.
What was it, like a 6 or something? No, but because he has tank, like if I did one contract, I would get $600. Like, sure, it might still be worth it from a percentage point of view.
Yeah, the amount stays the same.
Sure. let me take a look actually at that exact. Yeah, $6. Holy crap! See, I would do that, Howard, but I would do it at like 100. At 100, it's $11. So you basically get 11 grand.
85 seems crazy. I think like that's I got to look into that. I never really look far out. I only look like 2 weeks out.
Yeah. Well, I mean, this is what TJ is now doing. He's doing like spreads where he's going like 3 months or 4 months out. And so what TJ will do is like he would do the 85 deal, collect 6 grand, and then he would sell covered calls at like 140 or 145 for the same date, and then collect like another 6 grand on the other side. And then he would be like, okay, well, Hood by January of 2026 has to stay between 85 and 140 or whatever the case may be, right? And he would play both sides of that trade because one side mathematically is always going to be one.
But they just hold my money in collateral that whole time.
Yeah, like you can't use that. You lock up that money until January, basically. So whatever that percentage is, like let's say 6 grand is, whatever that is as a percentage, that's like your return, max return until that time.
Yeah, I've not sold puts yet. I'm just doing the covered call side. And also because I have no cash. I'm like fully invested.
I think like selling puts has absolutely been the more profitable thing for me. Where, yeah, of all my gains on running the wheel, selling puts is about 75%, and then covered calls is about 20%, 25%.
Yeah. Well, I think partly if you're like, I assume you're only counting the premiums of the actual contracts that you're selling, but not the appreciation of the stocks that you're holding.
No, I'm not. I'm like, obviously it's counted in my broker, but I'm like counting the premiums from a cash flow perspective. I'll share my screen. Maybe
Because
when we go.
The reason why I like covered calls is because it doesn't change my strategy on investing. Like it literally is just like for me, especially it would change my strategy if I wrote things with 60 delta. But the fact that I'm going out so far, as long as it doesn't turn sour on me, especially writing them on companies like Nvidia, for example, which I even feel more comfortable doing with a higher beta because it needs to like, in order for it to appreciate that much is hundreds of billions of dollars.
Yeah.
So I feel a lot more comfortable with that having.
Yeah, it's like TJ says, right? Like you're manufacturing a dividend for yourself.
Yeah. While still appreciating the stocks that I'm holding. Like I still can enjoy the appreciation of Robinhood and SoFi and Nvidia and all these. So
yeah, it's crazy. Like I started this and like, I mean, people watching, they sort of know my entire journey of like starting this as a strategy where I sold the entire dividend portfolio and started this instead. And it's going to be a 6-figure premium year. I mean, it's already a 6-figure premium year, like just about. But since I started in October, I want to see like October to October what I end up, and that's like locked. It's whatever the stocks did. Oh, you missed out on a 5x Tevis, or you missed out on a 10x, or whatever the hell in between. It's like, okay, well, this is money in the bank essentially. Like I got to pay taxes on it, sure, but like whatever, it doesn't really matter. Like you're paying taxes a percentage of the gains. So it's a really cool strategy, and I like it. It keeps me more active,
yeah. I don't personally think that was a good selling point. I mean, the percentage change means a lot more to me than the just sheer dollar amount because that'll be different per person. But
yeah, but like it also helps me, like it helps you lock in. Like HIMS was my best example where I basically got an entire position through cash secured puts on HIMS in the 30s, and I let that position go at like 47, 48 or something like that. And then when HIMS came back down it came back down in the 30s, I did it again and I flipped it again. I think I let it go at like 50 or 55 or something. And And basically HIMS is still at 50 right now. And so if I had held throughout that entire time, I would have had like a massive unrealized gains and then back to break even, and then massive unrealized gains and then cut like, back to 50% gains or whatever the case may be. And so this time I was able to take advantage and lock profits along the way. Now, of course, if it's a compounder like, Robinhood, for example, where they've just been going up, 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 and that's it, then it's a little bit different. But like even on those, I can just like on something like Robinhood that only goes up, or Palantir or Rocket Lab, or I don't know. You take your pick of the litter this year. You can just write cash secured puts, and I was writing aggressive cash secured put. Like, dude, HIMS was at $48, $47, and I posted a screenshot on X writing puts at $55, like with $7 baked into the price, and then it just shot up to $60, and I was like, okay, thank you. Like, I'll close out my puts. And it was just free premium that you got because the market is on such a risk-on environment, right? And so I think like in this type of market, your covered calls are going to be underwater, but you can also get a little bit more aggressive on the puts side of things because like you can capitalize on more premium that way.
Yeah, no, I'm not anti your strategy. I just love the passive ability of buying and holding. And yes, things can go up and down, but
yeah.
At least in my case, not in my case, in the market's case, stocks go up. I mean, like HIMS is a weird example, but even that, like it's gone from like 4 to 50. If you were to be underwater on some calls there, I mean, that would be a bad place to be.
Yeah, I mean, I don't really write covered calls on it. HIMS is the only thing. I'm looking at the thing right now. Like everything is green except for HIMS covered calls. Like that's the only quadrant that's like red. I think I'm like down $500 or whatever because I just got down underwater and then I had to like eventually pull myself out a bunch of times or let the shares go. But yeah, I don't, And then to answer Ozzy's question, like I usually do 2 weeks, 3 weeks. Sometimes I do monthly, and then sometimes like every blue moon, I'll do like, 2 or 3 months out. And then my goal for 2 or 3 months out is just like 60%. I'll close it.
Yeah. Aside from that, man, I don't know if we have any other news to cover on the week, but I do have some other stuff I want to talk to you about in the after hours.
Yeah, sure. We can jump there if you'd prefer.
Ladies and gentlemen, below where the subscribe button is, if you haven't already pressed that, there is a join button for you to join over to the after hour show. But if you're not there, that's perfectly fine. It's just two guys talking. That's all. And we'll be live again, probably throughout the weekend and weekdays and everything, whenever Tevis is available to be on TikTok or wherever he is at throughout the week. And thank you all so much for watching and joining and supporting the channels. And it's been very lovely to talk stocks. Okay, this outro is 5 minutes overdone. Bye for now.